Reserve Bank has released its financial stability report. The report highlights that banks continue to post robust credit growth and are seeing an improvement in their asset quality. Ritu's here with more. Ritu, take us to what else the report says.
Well, Shireen, lots contained in that 180-page report, but I'm going to focus on the macro stress test, which is not to be seen as a projection, but rather an estimation of how well equipped the banking system is to withstand any kinds of shocks. The big takeaway from the report really is that no matter the severity of the stress, as per RBI's assessment, the system is well placed to wither these shocks in terms of capital requirement. And in the baseline scenario, you should actually see the asset quality of banks and even NBFCs improve in a 12-month period by March 2025. So RBI says that the return on assets and the return on equity for banks are at decadal highs. Gross NPA and net NPA ratios are at multi-year lows, and all of this has helped them maintain a very good, strong capital buffer. In terms of asset quality, if you look at the macro stress test, for all scheduled commercial banks, which is a sample size of 46, including public, private and foreign banks that RBI has taken into account, the gross NPAs are actually expected to fall from 2.8%, which was recorded in March 2024, to 2.5% in the baseline scenario. They may be maintained at 2.8% in a medium stress scenario and rise by about 600 basis points to 3.4% in the worst case scenario. Now, among the various categories of banks, public sector banks are expected to see the highest increase in their NPAs in the worst case scenario. 3.7% is the GNPA that public banks reported as of March 2024, which is expected to rise to 4.1% in the worst case scenario and improve to 3.3% in the baseline scenario. Similarly, for private banks, the 1.8% GNPA is expected to improve to 1.6% by March of next year in the baseline scenario, and in the worst case to 2.8%. If you look at the capital adequacy of all of these banks, again, RBI says that no matter the severity of the stress, they will still be able to maintain the minimum capital regulatory requirement, whether that is measured by CRAR or the Tier 1 capital equity ratio. The current level CRAR is at 16.7%. For the system as a whole, much above the minimum regulatory requirement, which is at about 9%. And even in a severe stress scenario, it may fall to 13% by next year, whereas the CET1 ratio, which is currently at 13.8%, in the worst case could fall to 10.8%, again, much above the 5.5% minimum regulatory requirement. Now, even for NBFCs, if you look at the picture, on the asset quality front, there is expected to be an improvement in the baseline scenario from 4% currently to 3.5%, but the capital adequacy may actually fall even in the baseline scenario, and as many as 8 NBFCs may not be able to maintain the minimum capital requirement. This is on the back of the measures that RBI has been announcing, but overall, RBI is confident that the banks are well equipped to support the growth of the economy.
All right, Ritu, many thanks for joining us. With that, it is time for us